Hello, students. I want to talk. One of the students posted an interesting post that actually two students, and there were many good postings. Just I selected two of them. One of the students said that is the S&P 500 the safest way to invest in shares. I want you to know what S&P 500 is. S&P 500 is a basket of stocks. Baskets of stocks means there are 500 stocks in the portfolio. Imagine that you have $500 and you want to invest in S&P 500. You give your money to the brokers. Let's say that broker is Robinhood. When you give $500, one way to look at it, this Robinhood takes this $500 and puts $1 of it in Apple, $1 in McDonald's, $1 in Walmart, $1 in Costco, $1 in Microsoft. Therefore, you end up being the owner of all these companies. That means these are 500 companies. You will be the owner because you are buying them. By how many shares? You are not buying one share. You are just investing $1 in each of them. Now the question is that, is this a risky investment or not? When would you lose your $500? One way to lose that if Walmart goes out of business, McDonald's goes out of business, Apple goes, the possibility of 500 important companies, in the US go out of business is very low. Therefore, your $500, you won't lose that money, because if one day all these companies go out of business, let me assure you, all of us are going to lose our jobs. The US economy, everything will go down the drain. Therefore, it is relatively a very sound and safe investment, because you are not investing in one company. You are investing this $500 in 500 different companies. Therefore, here it is consists of, S&P 500 consists of 500 US companies. And these are important companies. And these companies are market leaders. And the historical performance in the past, let's say, 30 years, they have gone by 10 to 7%. If that is the case, why should I put my money in the bank and get 2% interest? Well, while I can on average, but it is based on assumption that you put your $500 and you don't take the money out 1 week or 1 month or, from away from now. Because if you do that, there is a possibility that the stocks maybe drop a little bit. Therefore, if suddenly after 1 month you want to sell it, your 500 might be 490. You don't want. In longer term, let's say 2-3 years, you will see your 500 goes up by 7% or 10%. 10% of 500 is $50. That means on average, for example, your $500, $50 on average goes, is added to your $500. Therefore, it is a passive investment. Passive investment, the meaning of it is that you give your money to Robinhood, they take care of it, and they put it on ETF. ETF means that basket of the stocks, that exchange traded funds, basket of the stocks that are traded on, stock market. Therefore, are there any risks? Yes, the risk is market risk. Market risk is when it is volatile. I just told you that it is possible. This Apple or McDonald's or Tesla or whatever, these companies, their stocks go a little bit down. If they go down, then you might, if you decide to sell them, then of course, you lose part of your 500. However, if you want to keep them, the history has shown that they will come back up. They will come back up, and later they go at a rate of 10%. Therefore, you end up being a winner. Sometimes the students tell me, one of the students asked a very good question, and she said that, I don't know which stocks to buy. That's okay. If you don't know, the best investment is this S&P 500, because it is 500. You don't need to know any of them. Just you will put money in this S&P index, and then it will provide you the average of 10%. Sometimes it might suddenly drop significantly, like in 2008. Suddenly initially maybe it lost 20% of it. 20% of $500 might be $100 went down. It became 400. But guess what? Quickly it came back up. And if you've invested $500 in S&P, let's say 20 years ago, for example, if it went up at 10%, that means in 1 year it will be, in 10 years it will be almost double, more than double. And in 20 years, it is triple or quadruple. That means that your $500 20 years from now most likely will be 2000, 2000 something. Therefore, it is a much better investment, if you ask me, comparing to that, putting it in the bank and getting 2%. And I'll tell you later why it is a bad idea to put your money in the bank and get 2%. The reason to it is that 2% is less than inflation. When you put your money in the bank, and you get 2% interest, in fact, you are losing. Why? Because inflation is more than 2%, it's 3%. That means you lose 3% because of inflation, you gain 2% because of interest. That means at the end, you lose 1% of your money, regardless, However, putting in S&P and keeping it for a longer time, 3 years, 4 years, 5 years, then why not? You are getting an average of 8 to 10%. Best deal that you can find. Smart people like Warren Buffett are encouraging the people who do not know how to invest. Go and put their money. If you put your money there, then you make good money. And not only that, I was talking to the college yesterday. They asked us if we had any suggestions for applying for grant. I said I am teaching a course in personal finance, and I said my students don't know the importance of the stock market. And when I asked them to go and open account with Robinhood, they were scared to invest, let's say $50. Therefore, I asked the college, if possible, the college asks for a grant. That way, we can give $50 to each student that takes personal finance. Of course, it won't happen for this year, but next time I teach this, my plan is that hopefully the college give me money. That way, we can give each student $50 to go and invest in the stock market, to learn the habit. If you want to have a good future, you have to understand. You are a business student, accounting students. It's very important to understand the importance of investing in the stock market and preserving the value of your money. Otherwise, you will fall behind. You know what Warren Buffett has said? Warren Buffett once said that if you are not making money while you are sleeping, you are going to work until you die. The meaning of what he meant was that, that means when you are sleeping, you are making money, means that you have invested your money in some good investments that they can bring you money while you are sleeping. Some people think that, because if you don't have a good investment when you are sleeping, you are not making many money. You are just, you make money only when that means that you will be a poor person all your life. Therefore, this is what this student posted. Another student said that she had asked what companies are coming to primary market. Primary market is that stock market is a secondary market. Primary market is, some of you have heard of IPO, initial public offering. The meaning of it is that, let's say you are an entrepreneur, just like Elon Musk, you go and start your own company. After your company might becomes big, then you come and say, oh, let me go ahead and sell stocks of my company. You take your company to maybe an investment bank or somewhere. Say you want to put it in the stock market. That way you can sell some of the shares. Then what they do is that they bring it as a IPO, initial public offering. First, they offer the shares, to selected people who are rich. And after they initially selected, that is called primary market. Then after that, they bring it to the regular market, like, regular stock market. That way, other ordinary people can buy the shares. Therefore, that's what primary market is. And the computer ChatGPT has said these are the new companies that, some people like to invest in primary, market before they come to the stock market. It is a risk, but those who are rich, they want to take a risk. just in case suddenly during primary market, when they first come to the market, suddenly the stocks might go up significantly or they might drop significantly. Therefore, and then this student is saying that if she is invested in 2004, she invested in Glad, at that time it was $15. Now it is $24. Was it a good investment? Overall, I would say maybe it was not a perfect investment. Of course, this excludes the what is that called? That means the stock has increased 63% in 20 years. If you divide, that means at the end it says that her $1,000 has been converted to 1,630. Do you see? It is not that much of an investment. The reason to it is that only she has made over 20 years. She has made how much? $600. That means that's an average of 2%. 2% or 3% is not that much of an investment. That means that all that the student has done is that she has preserved her money. Therefore, if the same student had put this money in S&P, then in that case, her $1,000 would have been, at 10%. That means in 10 years double, in 20 years, again, that double quadruple, that quadruple. That means that her $1,000 20 years ago, most likely, if you ask me, would be $4,000, for example. Therefore, and she would have been much more safer. Why? Because here she only invested in one stock, which could suddenly go down and she could lose everything. But if she had invested in S&P, she would have invested in 500 different companies, and now she would have $4,000 rather than 1,600, 3,000, 4,000. Therefore, it was not, this stock has not been, great. Of course, it had given dividend. Dividends means interest, and sometimes stocks give dividends, interest. Therefore, the dividends, you may think that this has come to 2,000. Her $1,000 doubled in 20 years. It is not, overall a great investment. I asked ChatGPT about how you all can invest in S&P. I want you to read that, and I want you to think about it as well. And as I said, next time, hopefully I teach this course. I will have I am hoping, money for students, give money, our college will give, foundations will give money to students to invest. That way they learn, and that fear goes away from the minds of the students. If you have any questions, let me know.